The biggest mistake traders make is starting a challenge without running the numbers. They blow accounts not because their strategy is bad, but because the math doesn't add up. In this video, I'll break down the exact numbers you'll need to know if your strategy can pass a prop firm challenge before you even buy one. So the first two numbers that you need is your win rate and your average risk to reward. Once we have your win rate and your average risk to reward, we can now calculate your expectancy. And what your expectancy basically does is it tells you whether you make or lose money on average. The easiest way to show you how to use the calculation that I'm about to give you is to give you an example. So let's say you have a trader who has a 50% win rate and a 1 to 2 risk to reward. How we calculate what the expectancy is we take the win rate, 50%, 0.5, times by the risk to reward. So it's 0.5 times 2, which gives you 1. And then you subtract it from your losing rate times what you lose. So what I mean by that is you've already got your 1 and you subtract from 0.5 because that's your chances of losing. If you have a 50% win rate, it means you have a 50% lose rate. So it's your 0.5 times 1, which gives you 0.5. So now you've got your 1 subtracted from the 0.5, which gives you 0.5. Your expectancy for this particular trader is 0.5 R per trade. Basically, the formula here is your win rate times your average risk to reward minus your lose rate times 1, and that will give you your expectancy per trade in terms of R. To drill this down, let's use another example. And instead of a 50% win rate, let's say that this trader instead has a 80% win rate and they use again a 1 to 2 risk to reward. We use the formula, my win rate, which is 0.8 times by 2, which gives me 1.6 minus in brackets 0.2 times 1, which is 0.2. So effectively we've got 1.6 minus 0.2, which gives you 1.4 R per trade. So you can see that this trader has a higher expectancy than the previous one who had a 50% win rate. Why? Because he has a higher win rate, but he has the same risk to reward. But expectancy alone isn't enough, because you can have 0.5 R per trade expectancy, and if you're risking 1%, that means that you are making 0.5% per trade. But if you only take 2 trades in a month, you're only realizing 1%. The next factor that we need to take into consideration is your average frequency, i.e., how many trades do you take per month? And the number of trades you take per month is a huge part of whether you pass or fail a prop firm challenge. And there's a couple of reasons for this. And the first reason is sample size decides your consistency. The higher the number of trades that you take, the faster that your edge plays out. The less trades, the longer it takes for your edge to play out. So if you take 100 trades in a month, your edge plays out faster than someone who only takes 2 trades a month. Because for them to reach the same 100, if we were basing it on 100 trades to reach your particular edge, well, the first person with the 100 trades gets it in a month, whereas the person who takes 2 trades per month, it'll take them 50 months to realize their edge. And the second reason is your drawdown exposure. The less trades that you take, the more those trades matter. Whereas if you take more trades, it means that your risk is more distributed and you've got a higher chance of passing because your losses are spread out. Now that we've taken into account that we also need our frequency of trades, we have our win rate that we need to know, our average risk to reward, and our average number of trades per month. So let's now use the example that I gave earlier. So that same trader who had an 80% win rate and a 1 to 2 risk to reward, I said that they realized a 1.4 R per trade frequency. Now let's say this trader only takes 4 trades per month. It means they are going to make on average 4 times 1.4 R in a month. That means that in a month, they're going to make 5.6 R. If you want to reach the profit target, and most firms it's 10%, then effectively for this trader to reach it in a month, they will need to risk 2% per trade. So let's compare it to our trader who has a 50% win rate, average risk to reward 1 to 2, but they take 20 trades a month on average. Well, we explained that the expectancy is 0.5 R per trade. If they take 20 trades, that means that they reach 10 R in a month on average, which means for them to reach that 10% target, they only have to use a 1% risk. Let me just show you something as well. The trader who's taking the 1% risk per trade, they have 10 chances to blow the account. because as much as we're talking about the good and reaching the profit target, we also need to talk about the bad, because in trading, there is good and there's bad. And we need to think about both. In the case of the person risking 1% per trade, they have to lose 10 trades in a row before they blow the account. The trader who's risking 2%, they have only 5 trades and they blow the account. So you can see how even though trader A has a lower win rate, they have a higher frequency, and therefore they have a higher chance of passing an account than the other trader with a higher win rate but less trades, because of the pure fact that the first trader can take 10 trades to lose their account, whereas the trader with the higher win rate, they just have to go bust on 5 trades and they've lost their account. And that's why it's important that you know your numbers, because when you know your numbers, you can use the appropriate risk. Because the problem is a lot of people, they look online and they see one person will say use 0.5% risk per trade. Another person might say use 1% risk per trade. Other people are using 3% risk per trade. And these are all general tips that don't work for you as the trader, your individual circumstances. That's why you need to know the math yourself, and then you can choose your risk appropriately. At the end of the day, trading is not about luck. Trading is about numbers. That's why it's important that you know your numbers. And once you know your numbers and you know what risk to use, the next thing you need is to find a prop firm that works for your strategy. And if you're looking for a prop firm that seems quite reliable, customer support is good, and they have fair rules, I have a discount code in my description for Blueberry Funded. If you use the code DANPR7, you can get 20% discount on your purchase. If you'd like to try them out, let me know how they are. And besides that, I'll see you in the next video.